Hello traders, this is Adam from Alphachain Capital. Welcome to this video on building an automated moving average trading strategy. We'll begin by covering the basics of what a moving average is and the various types before moving on to TradingView, where we'll start to code our moving average strategy with Pine. We will then perform an automated backtest to show how the strategy would have performed over the last few years, and then build a script to forward test the strategy with automated signal alerts. By the end of the two-part series, you should be able to build a moving average strategy with automated trading signal alerts in TradingView. So let's get started. What is a moving average? A moving average is a technical indicator, a very common one, used by traders, which helps us to determine the trend of a market. It shows the average price of an asset over a set period of time, which moves as new data is added to the chart, creating a trend line on our chart. So some of the key features of this indicator: it shows us the trend of the price of an asset, so whether it's moving upwards or down. It shows various types. There's various types of MAs available depending on your purpose. So we'll go into that a little bit later on why you might use different types of MAs. 3, it can be used as a signal to help us identify when the trend might be changing. And finally, it has the effect of smoothing the price data. So let's have a look at what that may look like. Here we have an example of a 30-day exponential moving average on the daily chart for Ethereum. So as you can see on the chart here, the price is very choppy. We can see how the EMA, the blue line, smooths out the price over the whole chart. On the left side of the chart, we can clearly see there's an uptrend as the line slopes upwards, and on the right hand side we can see that prices fall, the line slopes downwards, showing us a downtrend. Very easy for us to see that on this chart. So what are the different types of moving average that are possible? So there are 3 main types of moving averages that are used. The most common is number 1, the simple moving average. So this calculates the average of the past n prices, equally weighting each price, where n represents the number of periods for that moving average. So for example, you could have a 10-period simple moving average where each point has an equal weighting in the calculation of that average, so on the line. Second, you could have an exponential moving average, also known as an EMA. This calculates the weighted average of the past n prices, providing recent prices with more weight than previous prices. The difference in weightings is exponential. So this could be considered a faster moving average. So it usually reacts faster to prices than a simple moving average would. Finally, we have a weighted moving average. So this is similar to the EMA. It assigns more weight to most recent prices. However, the rate of decrease in weightings between one price and its previous prices is consistent. So whereas with an EMA, the change in weightings is exponential, with a WMA, it's a consistent change in weightings. So the question is, what would you choose? So there's 3 different EMAs, moving averages there that you could pick between, and different traders use different ones for different purposes. So I have my own preference. I have a personal preference for the EMA, the exponential moving average. I believe applying greater weight to more recent prices is more accurately reflect the most recent trend, whereas an SMA is equally weighting old or outdated data with more recent data, slowing the effects of any recent trend that may be appearing. Many traders have their own preference on which they prefer and why. This is just my personal opinion. You can choose whichever you want based on your own research, and we'll go into that a little bit later. For this strategy, we're going to be using an exponential moving average technical indicator. So let's look at how they vary, the 3 different types. So here's a chart, the same chart again. It's Ethereum with the 3 different types of moving average on them. So this is the way that you can just kind of see the differences visually between them. We can see that the slowest moving average on this chart is the simple moving average in green. It consistently lags the other 2, the lowest on the uptrends and the highest on the downtrends, which we can see on the chart. The fastest moving average is the exponential moving average in blue. We can see at the beginning of the trends, the EMA is the first to react to price changes. So over here, for example, we can see it's the first to react to price changes, and on the way down, it's also the quickest to react here. Also in the uptrend, you see it move quicker as well. So it's the fastest to react to prices. Okay, great. So before we go into developing the strategy and building it, I wanted to just go through the research process. This is what a comprehensive research process would look like when developing a new strategy. A significant part of the time spent in developing a strategy is spent on the hypothesis stage, on the research. So everything above the line. So this is where we are observing data. We look at various different types of data, whether it's price, volume, whatever it might be. And we're looking to find patterns that we might want to form hypotheses from. So for example, we're using a moving average indicator. So we might simply say the underlying market shows many types of trends, long-lasting trends. Therefore, we feel a trend indicator might help us create some alpha in our strategy. Alpha is outperformance, just very simply. So the first three parts: observe data and research, form a hypothesis, and then we validate that hypothesis using statistical analysis. Now, for our purpose from this video, we're going to consider we've done all the first three parts, and we're just now going to focus on everything under the dotted line. So we're going to focus on coding our strategy, putting that into code, developing it, backtesting in sample, so backtesting it for a certain period, and then we're going to forward test that sample, forward test the strategy in out of sample. So out of sample is the rest of the data that we haven't already backtested on. Good. Okay, and now on to the actual strategy, the EMA Trading Strategy. So this is the strategy which we're going to be implementing. The strategy is always in the market. It's either long or short, based on the price crossing the 20-day exponential moving average. Okay, so we're waiting to see when the price crosses above or below the 20-day EMA as a signal to trade. The logic: when price crosses above, we go long. When price crosses below, we go short. Very simple strategy. There's nothing too complex here, and I think it's important to take away from this video that, you know, I don't recommend that you trade this strategy. It's extremely basic, extremely simple. This is mainly just meant to show you as a demonstration how you can build one. The idea is that you can learn from some of these tools and develop your own with different indicators. Okay, so now let's get into the actual TradingView screen and see how we might be able to start coding this. Okay, here we have the Ethereum chart. We've opened up the Pine editor. This is where we input all our code to develop our strategy. The above is obviously the chart for Ethereum versus US dollar, and we're currently on a daily time frame. You can choose any time frame you wish. This is just one that I'm using for demonstration. Okay, so we first need to initiate our strategy. So there's certain things we have to do to begin to structure our strategy, to let the code know that we're building a strategy. And what I'm going to do is I'm going to copy and paste the code from another screen, just so it doesn't take forever with me typing it in and you guys following along. So first we initiate the strategy with the following. So this is how we initiate any strategy. Always starts with the strategy, and we put the name of the actual strategy in inverted commas, 20-day EMA, and initial starting capital. We're starting with $10,000. Currency is in US dollars. Next, we want to choose a resolution. So when we backtest this strategy, we want to always have it based on a default resolution. So our resolution on this screen is daily. So we always want the backtest to be done on the daily resolution. So that can be done with this simple bit of code here, which shows resolution. This shows that we always want the resolution to have a default value of D for daily. Okay, so whenever the backtest is performed, it's always doing it on daily data. Next, we want to create our order size. So how big do we want each trade to be? We know our initial starting capital is $10,000, but what do we want the trade size to be? So we'll create a new variable called order size. And what we're saying here is that we want the order size to be approximately 50% of our equity. So strategy.equity is the equity in the strategy, obviously. And the initial capital is $10,000. So we're saying we want this order size to be no more than 50% of $10,000. Now, strategy.equity should change as we go through the backtest, as we make more money. the capital, the equity will increase, and therefore our position size will increase proportionally, being 50% of the equity at that time. We divide it by close because we want to choose a number of contracts to trade. So on TradingView, you trade with contracts. So you divide it by close, and that tells you the exact position size. So obviously, if you can change your position size by changing this 0.5, that's obviously 50%. You can adapt that accordingly as you see fit. Next, we want to use price in our strategy. So we create a constant called price, which is the close. Okay. The close is just in constant, really isn't the correct terminology there, to remove that. The price is something we'll use later. It's just showing us the close at each point, which will go into the variable price. Now we'll begin to code our indicators, which is our EMA. So remember, we wanted to use a 20-day EMA. So let's start with the first part of our indicator. Okay, the EMA, we've input the first part of this indicator. It's very simple to code this. So all we're stating here is a value for EMA value. So we're stating that EMA value we want to be 20. And we're going to call that the EMA. So 20, we're inputting here the period. So the 20-day EMA, this is the 20 part. We're feeding into the variable EMA underscore val. And then second half is where we're actually using the EMA val here, which is the 20, and the close to form the EMA. And we're feeding that into the variable EMA underscore 1. Okay, so this is calculating the EMA, which is already built-in function. We're calculating EMA based on the close over the previous 20 periods, because EMA val is equal to 20, and we have that here in our function. Great, so now we've just coded our EMA, our 20-period EMA. It's as simple as that. Next, we want to create our signals. Okay, so we want to choose when do we want to buy or when do we want to sell. So a lot of this is just pure logic. So let's see what that looks like. Let's remove these just to keep it clean and simple. Okay, so a long signal. We want a long signal when the price, which we know is the close, is greater than the EMA underscore 1. So when it's greater than the EMA, which we've just coded here. So when a price is greater than EMA, 20-period EMA, we want the long signal. And the opposite. For a short signal, when the price is less than the EMA, we want to go short. It's very easy to code that. It's just simple logic. And there we have our signals created already, which is excellent. Now, I'm going to put a small variable in here, and I'll tell you why I'm doing this a little bit later, but it's there for now. Okay, length equals 2. Now we want to code our trade in execution. Okay, so what we have initiated the strategy up here. We've chosen our selected resolution that we want to use for the backtest. We've chosen our order size. How big do we want each order size to be, each trade? We've coded a price in, so we can feed in some price into the logic here. Then we've made our indicator. And then we made our signals. So let's just put this in here for clarity. Here's our signals. This is a variable we'll come back to shortly. And now we're going to do our trade execution. Okay, so this is actually putting on those trades based on everything above. Now, as we said earlier, this strategy is always in the market. It's either long or short. Okay, so we're going instantly from long to short. We're never out of the market. We're never just sitting in cash. So let's start with the long strategy, the long part. Okay, so you always initiate strategy. We don't always, but it's common to initiate a trade with strategy.entry. Okay, this is usually how you start opening a trade. We've given that trade entry a name, an ID. Okay, it's not too important. It's important if you're learning. If you want to close that particular trade, we need to reference this ID. For this purpose, it's not so important. Long is true because we know we want to go long. We're doing a long entry first. Let's just make that clear. Long. The quantity, so how big do we want this trade to be? We want the quantity to equal the order size, and the order size we already coded up here. It's 50% of our equity at any one point. Great, so we have that. When do we want this trade to be entered? We want this to be entered when we get a long signal. So when we see the price is greater than EMA 1, that's when we want to enter our long signal. Good. Comment, sometimes you can have a comment come up on your backtest long just so you can easily identify which trade is which. Good, so we've done that. Now let's do our short. Very similar process again. Strategy.entry, ID, called it a short signal. Now long equals false. That means we want to go short. So you don't put in short equals true. Long is a variable. It's either true or false. It's a Boolean value. Next quantity, again, quantity is going to be order size. When short signal, the price is less than EMA. We already coded that. And comment as a short trade. So we identify this one. Good. That is the majority of the code done. Very simple to code. It's a very simple strategy. And we've done the majority of it already. But what we might want to add some little plotting on our screen so that when we backtest, we can see our EMA. At the moment, we won't be able to see our EMA on the screen or just show our entry and exit points. But it's always good to show your indicator alongside it. So let's plot that. Plotting. So we've made the variable P1, use the function plot, and we're plotting the EMA 1, which is what we've coded up here, which is a 20-period EMA, giving it a color blue, and line width is 1. So let's see what happens when we add this to the chart. So when we've got everything ready, I recommend that you do save it. So let's save it. Okay, 20-day tutorial. We save that now. Let's come up here. Now we add it to chart. So this comes up as a default 1 day because we stipulated here we want the resolution to always be a default value of daily. Great. Apply. Excellent. Well, here we go. We've just plotted our strategy. Now we can see our EMA, the blue line, all the way along on the chart. We can see our long and short positions. So when we went long, when we went short, long, short, very clear. And we can see our equity, our change in equity over the whole period. So the blue line is how the equity is changed over the whole backtest. The red line shows our drawdowns. And here are our stats for this backtest. Okay, there's our net profit over the whole period. This isn't annualized, it's over the whole period. Total number of trades. Percent profitable, so just over a quarter of those trades profitable. Profit factor, our max drawdown, so a max drawdown we had during the back test was 38%, so quite a high drawdown. And the average trade was in 10 bars, so that's 10, each bar is 1 day because we've got a daily time frame. So that's showing that the average trade is open for 10 days, which is interesting. So we can also look at a summary of the back test. There's lots of interesting data we can look at. Our net profit, gross profit, difference between longs and shorts, which performed well and which didn't. Profit factors, lots of interesting stuff there. Average win, average loss, largest win, largest loss. Lots of stuff you can dive into and get to grips with. But more interestingly is our list of trades. So this lists each and every trade that we had in this back test. So how many did we have? We had 153 of them. It lists each and every one, the price we entered, the price we closed at, the date, the position, so short, long. Remember, we just keep swapping from short to long, and the P&L. Okay, so the profit of each trade. So let's have a look. We can quickly have a look through here. It's a few good trades. You can see a 422%. I mean, of course, when in this type of market, when they're trending, trend following strategy can do quite well, but as I said to you before, I recommend you don't follow this strategy. It's not always going to perform well. It's just meant for guidance to show you how to build your own trend following strategy. So lots of great stuff we can see here, okay? And this gives us an overview of how it performed. Now, if we look back on the chart, we can see there's lots of times where we've entered, we went long, short, long, long, short, long, short, and it's quite choppy. Now that is the nature of some of these trend following strategies. When markets go sideways, they don't perform as well, but when they trend up like this, they perform pretty well. Right, that's it. That's the nature of a trend following strategy. When trends are there, they do well. So there are ways where you can actually minimize choppiness. That's where this len comes in. So I'm not going to go through it now because the video is already quite long. But with len, you can actually change the time between signals. So for example here, that you can use a function called bars since. You can Google it to have a look at how it works. And you can say bars since certain signal. If that's been more than 10 bars, then we will have a new signal. Right, so that makes sure there's certain time periods between each of these signals to stop the choppiness. That's something you can look at in your own time. Unfortunately, we haven't had time to talk about it in this one currently in this video. But look, that's simply it. That's how you create your backtest, your strategy. Very simple, not even a lot of code. Very simple to do. So now you can analyze to see how it performed, and see if you liked how it performed. You know, it's good to go into certain periods to see how they performed in different market structures, in uptrending markets, downtrending markets, sideways markets, to see if there's something you like to explore further. Okay, and that's the coding part for now. And now we go back to the slides. A couple more things to cover. So just discussed, this is the strategy we just coded, the long short price above 20-day EMA. Overfitting, so this is an important part that we need to discuss. It's a very big issue in backtesting, and something you should always be aware of when you're developing these strategies. So what is overfitting? Overfitting is when you fit a strategy too closely to historic data points where the backtest performance is not likely to represent real live trading performance. Okay, so this is saying where you make such a complex strategy that it fits perfectly to the previous data points that have happened already, but that's unlikely to repeat itself, right? We know that history never repeats itself, certainly not with regards to price and assets. So this means that if you were to do that, you were to overfit your strategy, when you live trade it, the performance is going to be very different to what you expected in the backtest, usually a lot worse. Okay, that's usually what happens. So it's important to remember that history will not repeat itself in prices. It'll never happen. So there's a couple of tips you can take away to help ensure that you're minimizing the overfitting in your strategies. So firstly, just keep it simple. Some of the simplest strategies work the best, right? When you start to make a more complex strategy, it's more likely to be overfitted to previous data. So always remember to try and keep it as simple as possible. Secondly, it's good to have a large number of trades in the backtest. So ensure you have a good sample size. So the number of trades in a backtest. The performance of a strategy that has only 3 trades in a backtest cannot be relied upon as much as a strategy that has, say, 500 trades in the backtest, right? The more trades you have, the more you can trust the performance of that backtest because you've got more data points to look at. And finally, backtest only on a sample of data and forward test on the remaining for validation. So this is something you can look online on how to choose a window for your backtest. So if you only want to backtest on a certain portion of the whole data, you can do that, and I recommend you do. And why that's good is because you could backtest maybe on 60% of the data you have available. Okay, if you're confident, then you can start to forward test on the remaining 40% of data. Right, so what you're doing there, you're trying to avoid the overfitting by keeping a part of the data available for you to forward test, for you to check, okay, so if this is my strategy, it worked well on the previous 60%, let's see how it will work on the next 40%. These are just a few tips to take away that hopefully help you avoid overfitting, which is huge in systematic trading and these strategies. That's it for part 1. Up to now, you've coded a basic indicator into TradingView and back tested its performance. In part 2, we will create automated signals which will alert us when to buy and sell for our forward test based on this strategy. One thing to note, as you may have noticed already, we're not automating trade execution. Okay, we're automating the signal generation for you to trade upon. So this allows you to choose any platform or venue to execute the trade based on the signal being triggered, whether you're trading cryptocurrency, Forex, CFDs, whatever that may be. The signal will be generated for you and you can trade wherever you need to. I hope part 1 has been enjoyable and I hope to see you all in part 2. Thanks.